Welcome to the question debrief, and this question is called Mortexa Company. Now it's all about the M&A, reading through the requirements firstly, that part A number 1 calculates the pre-acquisition value of equity for both companies. One is for the Mortexa company, second is for ACCA company, which means the M and Y company, and estimates the additional value that would be created by the proposed acquisition. Now, number 2 is to estimate the impact of the acquisition on wealth of both shareholders and the impact on the EPS. Before we dip into the part A2 and part B related to the comments part, let's deal with the calculation part. Open up the spreadsheet and telling the examining team that I know the requirement, which means the requirement 1, I just copy and paste them there as a starting point. Okay, let's deal with the part A's first. And it's just to be a very typical calculation for requirements for the M&A type of question. Now, firstly, for the M and Y company and the additional value, so make sure that you will tell the examining team about this before you forget about that. So, which means the value of M, value of Y, and the additional value. You should answer 3 of them. Okay. Now, in our knowledge course, that we did talk about the ways that we answer this type of question. All right. So, what we then do, after we finish the part A number 1, we move on to part A number 2 requirements. We will then need to see to compare the value, okay, of the M and Y company before and after the acquisition goes ahead. Let's deal with the part A number 1 first. Now, we're told that M operates a nationwide chain of supermarkets in our country, in Southern Europe. And our supermarket sector is very competitive, but there's an increase of M&A activity over the last 10 years, because competitors seek to maximize economies of scale. In response to a decline in the company's profitability, the directors are proposing their own acquisition and have identified a regional supermarket chain called Y Company as a suitable target. But Y Company is not listed at the moment. Of course, when we are using PE ratio later on, so we will have different assumptions on that, particularly for the company that's not listed. We may need to make certain adjustments for that, but it's entirely up to you. But of course, when it comes to the comments part, in the next requirement, we can certainly comment on that. Right, so we acquired the Y company. So we click on the Exhibit 2, and that's where the answer is basing on. Now we're told that early discussions between both companies' board indicates that Y company shareholders are expecting a minimum acquisition premium of 20%. So we'll need to say that after the acquisition goes ahead, whether or not the share price will increase by at least 20%. Now, if this is not the case, of course, shareholders will be upset about that. And Y company's majority shareholders target for the EPS, and it's unlikely that it will approve any acquisition which will cause a decline in EPS. So that's why we'll need to see whether or not the EPS will go ahead to increase after the acquisition is approved. Now, our company's finance director is proposing a share-for-share offer, okay, to convince Y company shareholders to effectively invest in the future of the combined entity. The proposal is to exchange 3 of the target company share for 2 of our company share. So we will need to use that information when we come to the next part of the calculation later on. But there has been a rumour that Rival is also interested in acquiring the Y company. So that's why we'll need to estimate that value. Now we're told about the following information. Now when we talk about the M&A, so we need to determine that equity value. Now there will be a variety of ways that we can do. If we can see profit, please do use profit after tax and times by the PE ratio. Okay, that's important. Then we're told about our company's profit after tax of 548 and the Y company's profit after tax of 135. However, because our company is a listed company, we're told that our share price is currently at 8.22. Now, if I were to use the market cap approach, which means the market capitalization approach, we take our share price and times by the number of shares that we currently have. Because currently, par value of each of our share will be $1 and total share capital value will be $800 million. If I were to take 800 over 1, and that means that we've got 800 shares. So we can easily calculate the value of M. We use the market cap approach. We don't really have to say that in the exam. For example, we use the share price times by the number of shares. Okay, just to help me that I can slot the right information in. Now, the share price here, I will say that how much? 8.22 there as a starting point, and times by how many shares that we've got there. Now we've got 800 million over 1, so we'll take 800 over 1, that being $6576 million. Okay, so all in million. So how about for Y? Now, if for Y, because we are told about the profit after tax, so if you know about the PE, of course we can calculate the value of Y. Now, because both companies operate in the same industry, our company's CEO asks you to assume that same price earnings ratio can be used to value the Y company's equity. So if this is the case, then we can calculate our company's PE as their PE. Okay, so let's start working for this. Okay, why not? Working for a PE of the M company. Now, PE means that we've got the share price and we've got the earnings per share, or EPS for short. Alternatively, you can use the numbers in total. Instead of using share price, you can use the total market value. Instead, the EPS, you can use in total profit after tax, for example. We just calculated a total market value of the M company. How much? Well, 6576 there. What would be the total profit after tax? Well, we're told our company's total profit after tax would be 548. Okay, 548 there. So the PE, we simply use P over E, that becomes 12 there. Now, the profit after tax of the Y company, as we can see there, was 135. So we take 135 and times by the PE of the M company. So that being the value of the Y company, being $1620 million. That's it. Now, we're also told that the acquisition will create an annual post-tax cost synergies of $27 million. So if this is the case, then, to calculate the additional value, we take that synergy value, which means the cost saving that we estimated, and then we times by the PE. Yeah, I'm sure that you're quite familiar with that nowadays. Now, that being 27 times by the PE that we just calculated of 12. So if this is the case, then, and that's how we do it. Okay. Now, if this is the case, then, if we sum all these values, that becomes $8520 million. Now what comes next? We're also told that the company CEO believes that company's post-acquisition PE will increase by 10% if the acquisition is approved. Okay, now in this case, this means that after the acquisition goes ahead, the value should become, because you can see that we are calculating a value using a PE basing on 12, but we estimate that there will be an increase of 10%. So the value will become 10% more. So this means that equals to 8520 times by 1.1, which means 1 plus 10%. Total value being 93.72. So that's why when I answer this question to the examining team, the additional value after the acquisition will take the total value of 93.72 and to subtract the original value of both companies of 65.76 and 16.20. I will leave all the bits and pieces, including the synergy and the increase in PE there. So an increase in value will be $11.76 million, and that's all we can do. Moving on to the part A, number 2 requirement. Again, 5 marks, okay, just do the numbers right and leave it to the marker. Estimates the impact of the acquisition on the wealth of both company shareholders, including the impact on EPS. Okay, now I will say that impact on shareholders and then impact on EPS. Now my approach is slightly different from the examiner's one, because I would like to use the approach that I use in my class, very consistent each and every time. Now we've got the M company and we've got the Y company, which means the target company. And we will need to compare the new value with the old value to see whether or not there has been a gain as a result of the acquisition. Now M company certainly will be a buyer, which means the acquirer, and Y company will be a target company. Now let's calculate the acquirer firstly. Now firstly, what will be the O value? Because we're told just now that the current share price was 8.22 there for the M company. So it's not 8.22 there. But how about for a new value after the acquisition goes ahead? Now we'll say that as a starting point, the total value will be 93.72 there. Now, if you use the wrong figure there, absolutely fine, okay, absolutely fine. So we'll be applying the OFR rule, which means the own figure rule, to award you with the full marks. Okay. Now we take that total value, and because of the business combination, that currently that we've got 800 shares, but we are using the share-for-share exchange, so which means that for the Y company, currently you've got 450 shares. For every 3 of your shares, I will give you 2 of mine. So I will be issuing 450 over 3 times by 2, plus the original of our own shares of 800, and that will be a total shares. Now, because I take value over the number of shares, and that will give me the share price. Currently, is that we've got 100 million shares, and you've got 450. And for every 3 of you, I will issue 2 of mine. So if that's the case, then that comes to the share price of 8.52 there. So we'll say that there's been a gain, because I like to take 8.52 minus 8.22. If I were to express that as a percentage, I would take the gain over the existing value of 8.22. That give me 3.6% increase in value, okay, if the acquisition goes ahead. Now, how about for the Y company, on the other hand? I would say that for share exchange, to have and to give up, okay, so you need to label this, okay, to the examining team. Now, to have, right, let's do it. If for Y company, if you want to have the shares of the M company that's worth at 8.52, what's the term for you? What's the term for you? And if you want to have 2 of the M shares, okay, you need to give up 3. So you need to have 2 shares, you will need to give up 3. So you will need to give up the odds of 3. I mean, what would be the odds of 3? Now, I just calculated the value of the Y company. For example, was 1620. If I were to take that 1620 over the existing number of shares of the Y company, and in this case was 450, and that would give me the share price of the Y companies that we estimated. So you take 1620 over 450, and that will be the share price of the Y company. So, in order to get 2 worth at 17.04, you will need to give up 3. So we times by 3 there. So in essence, that the gain will be quite huge, because I will take 1 over another, minus another, and express that as a percentage. We take 6.24 over the existing value, so that would give me 57.8% increase in value. That's quite a lot. Now, how about for the impact on EPS? I would say that before acquisition and after acquisition goes ahead. Now, before acquisition, so what will be the EPS? Well, before acquisition, that the Y company, as you can see, because reading through the requirements, that for the Y company's EPS, now before acquisition, the EPS earnings per share, which means we take the profit after tax over the number of shares. We take 135 over 450. Okay. That would give me the EPS of 0.3. After the acquisition, the profit after tax total not only includes M company and Y company, and also synergy of 27. So you plus all these profit all together. So we'll take 548 plus 135 plus 27 over the number of shares. Now, not only that we've got 800 shares in total, but as a combined entity, I'll offer a share for share exchange. And from a combined entity's point of view, for that 450 over, I mean for every of your 3 shares, you will get 2 of mine. So I have to take 800 plus 450 over 3 times by 2. That would give me 0.6045 or something like that. I will say that, yeah, the EPS is increased. Now, the next requirement, Part A number 3, okay, 3 marks, 3 points, just paste them into the word processor, relatively straightforward this question really, and 1, 2, 3. Now, advise whether or not the acquisition is likely to be approved by both companies' shareholders. I will say that for both companies' shareholders, 1 seeing the increase of 3.7, 1 seeing an increase of approximately 57% in share price, I would say that both company shareholders are likely to approve the acquisition because share price is seen as an increase in 3.7% from M's shareholders. and 57.8 increase from Y shareholders. Now, is that the end of the story? Well, my answer and my gut tells me that no. Because although we're asking you advice, but we're also asking you whether or not. So it seems to me that I simply say my conclusion, although yes, I commented on my calculation result, so you will also get the A&E mark as the professional mark there, but that's not enough, because you also need to comment on the calculation assumptions there. Well, I would say that firstly, you'll be basing on the PE of the M company, and that may need to be further adjusted. At the same time, we also estimate there will be another 10% increase in PE, which may not be correct. So we can talk about this. However, the M's PE of 12 was used to calculate the value, which may be further adjusted to reflect the fact that Y company is not the same as M company, because Y company is an unlisted company. Okay, so that would be as a starting point. At the same time, the PE of 10% increase after the acquisition may also need to be challenged, as the estimate may be wrong. So if this is the case, then the calculation results may be further affected. Now finally, let's go through the part B, 7 marks here. I would say that rather complicated. The part B, not a lot of students score quite good in this part, but 7 marks, and I know there will be 7 sentences, and there should be 7 sentences there. Again, the best way, as you can see, explain the factors that the competition authority is likely to consider if it investigates the company's acquisition of a Y company. Now, of course, in some cases, the government may stop the acquisitions to go ahead, while the simple reason being that after the acquisition goes ahead, that you're reaching the monopoly position in the market, and that will damage the competition in the market, and of course hurting customers to a certain extent, because they've got fewer choices. So therefore, they may be likely to investigate the acquisition, or to pause the acquisition, for example. Now, we'll need to explain the factors, but again, as I said, you will need to look at the Exhibit 3 information as a starting point. Just copy and paste all the stuff into your answer, because that's where most of the marks are coming from. You will need to twist the answer, making a comment on that, and it's likely that you will gain very high marks by using this approach. Let's read through the exhibit. The competition authority in the L country is a government department responsible for promoting competition and restricting anti-competitive practices. Okay, I don't think that's something to do with our answer, just delete that. As a general rule, that department investigates any takeover or acquisition which creates a combined company with a market share of at least 25%. Although we predicted that our market share would be at 26%, only very slightly. Okay, so I would like to comment on the first point, for example, there. Now, twist the answer. Of course, I would say that M predicted market share after the acquisition would be 26%, which is above 25% rule by the department. The percentage or the threshold percentage, okay, you using that term will be vital for department to consider whether the acquisition is legal. Okay. Now, if it is not legal, of course, you will need to stop doing that. Now, at the same time, it really depends on whether or not, I mean, this is not something to do with the exhibit from my perspective, but it's just to be the textbook knowledge that you need to know, that sometimes the department may be using the principle-based approach. So, for example, that you're saying that the general rule will be at least 25%. So how about 24.9%? Okay. How about 25.1%? So I would say that sometimes departments may be using the subjective assessment for the marginal percentage, i.e. 24.9% or 25.1%, to assess whether it dominates the market. At the same time, the subjective assessment, again, is from the textbook. Okay, the department may also refer it back to the competitors' market share, i.e. basing on relative market share to see whether the acquisition will dominate the market. If you can't make these 2 points, absolutely fine, okay, just move on. Because I can see that the clue varies slightly. Yes, the examining team is giving us a hint about this. They lead them, really. Competition policy in the country recognises there's a potential for M&A activities to harm competition and reduce consumer welfare. For example, through higher prices, reduce quality, choices, or lower innovations. Okay, just to twist up. Now, the factors that should be considered, for example, the department would consider whether M's acquisition will result in higher prices, reduced quality, and lower levels of innovation. This means that M should prove with the business plan about these factors, okay, before it goes ahead with the acquisition. Okay, so that's very important. Now, of course, we can also see evidence, okay, from the competition. I mean, from a department's point of view, if they subsequently find out that after the acquisition you decide to lower your selling price, so possibly because of the competition is quite severe in the market, so that's why you can't increase your selling price, but instead you will decrease your selling price. And of course, that's reasonable, that you're not dominating the market. Now, another point is that if there's evidence that after the acquisition, the M company is likely to reduce selling price, this means is not dominating the market because the market itself is quite competitive. So these are the subjective factors that the authority would consider. Another 2 points. However, there's also understanding that M&A activity will benefit customers by promoting efficiency gains, which may result in lower prices. So I would say that because of this, passing the cost saving to the customer, resulting in lower prices through investment or job creation. So if that's the case, then yes, this can support my point. So just to cut it, and I would say that previous point, i.e. M can pass, okay, the cost saving, efficiency gains, can pass efficiency gains to customers, resulting in lower prices, blah, blah, blah. Okay, that's it. For example, there's an expectation that our company will achieve significant cost synergies, okay, if the acquisition is approved. In addition, okay, I've used that already. In addition, the company CEO believes that the combined entity will be able to invest in a new mobile phone application to help respond to competition from the online supermarket, and this will create new jobs. Okay, now, just to cut it, that's my number 6 there. However, the department may consider whether this can be done alone or must be after the acquisition. I mean, if you can do this pre-acquisition rather than after the acquisition, that this may be another factor that consider that this excuse is not reasonable. Finally, of course, yeah, any competition authority would therefore balance the benefit of takeover against the potential harm to competition. So I would say that, i.e., the department will consider whether the acquisition will damage the public interests. I mean, the public interests, yes, I can touch on that, saying that people's interests, having fewer choices, less innovation, lower quality because of less competition would certainly be a damaging activity to the public interests. So we can comment on that. I would say they're very tough, okay, so you need to have some knowledge regarding the competition authority. If not, twist the case information with your business sense, and that will be absolutely fine. So don't over explaining your answer, okay? Because according to the market experience that for such narrative parts in your paper, so getting 50% will be quite hard for most students. They simply bring back their thought without reading the exhibit, without linking the answer to the exhibit, but just to provide the irrelevant answer. So we will see that that will be an example of a lack of application in this paper. Right, that's it for this question. Hopefully you're happy. Best of luck.
APC, accounting for your future.